Welcome to CNBC.com. I'm Frank Holland, anchor of Worldwide Exchange. Today I'm joined by Graham Day, Chief Investment Officer of Innovator ETFs, to talk about the action in the ETF market. Graham, thanks for joining us.
Frank, it's great to be here. Thanks for having me.
All right, I want to start with a little data, Graham. According to Verify, net ETF inflows so far year to date, they're now over $597 million, putting us on track for another $1 trillion year. What does that say about the role of this investment vehicle in what's been a very volatile year and the investor confidence that seems to be in it?
Well, Frank, I think when you're seeing flows like that into the ETF space, and as you mentioned, over $1 trillion, we're on pace for over $1 trillion this year, is when we see uncertainty in the market. That's when we see advisors, investors flocking towards ETFs. And it's because it gives them a better structure, a better way to invest.
All right, so you're saying it's a better way to invest. You also are very focused on one part of the ETF market in particular. Defined outcome ETFs, some people call them buffered ETFs. They essentially mitigate risk by limiting downside, and also, in all fairness, they limit upside in most cases. You say defined outcome ETFs, they've been about 15% of launches this year, despite only being about 0.5% of total assets. Why do you think that an investor should consider a defined outcome ETF?
Well, Frank, as you mentioned, uncertainty in the market is at all-time highs. And what defined outcome ETFs allow advisors is to know their potential outcomes before investing it. And defined outcome ETFs are more than just buffer ETFs. We created this space back in 2018, launched the first buffer ETFs, expanded to 100% buffer ETFs. Now we've brought a new lineup, dual directional ETFs. But all of these ETFs give advisors the ability to know how much upside do they have, how much downside protection do they have, and with interest rates still going up, long-term uncertainty about bonds, uncertainty about where this market is heading, that's why we're seeing a lot of advisors looking to defined outcomes, and it's because they don't expect this rally to last. We surveyed hundreds of advisors. 90% believe that the market won't return more than 10% over the next 12 months. They're looking to stay invested, but also hedged.
All right, that's a very interesting set of data right there. So, let's talk about it. Volatility really seems to be the word of this week and really this year overall. What are a few defined outcome ETFs that you see as a good way to play this current market?
Well, Frank, one that I would point out, the ticker is DDFL. It's for dual directional. It's our 15% dual directional ETF. And what these ETFs allow you to do is to know exactly which positive or negative markets that you can make money in. And so you can track the performance of the S&P 500 up to a cap of about 8.7%. So in any positive market, you're going to track 1 for 1 up to that 8.7% cap. In negative markets, you can make money. In fact, you will track the inverse of the S&P 500, 1 for 1 up to an inverse cap of 15%. So if the market's down 10% over the next year, you will be up 10%. If the market's down 15%, you would be up 15%. This is a tool that advisors have been coming to us saying, look, we don't know what's next in the market, but a tool like the dual directional ETFs allow me to give my clients more certainty in terms of being able to generate a positive return over the next 12 months.
So, Graham, we're talking about this dual direction ETF. What are the holdings in this ETF? Because I would imagine it can't just be equities if it's giving you upside and downside protection.
Well, all of our defined outcome ETFs utilize options to provide the certainty for all of our investors. And so the dual direction ETFs are built the same way as our buffer ETFs. And advisors have grown to have a lot of confidence in these ETFs because they do exactly what they say they're going to. And so the options are what give the upside exposure as well as the inverse performance in negative markets as well. And one thing I would highlight, Frank, is these are not actively managed strategies. These are set it and forget it strategies where over a 1-year time frame, once the basket of options on the S&P 500 are set, we don't touch those options until the end of the 1-year outcome period. That is what delivers all of our investors a defined outcome so they can know exactly what they're going to get in any market, positive or negative.
All right, Graham Day, Chief Investment Officer of Innovator ETFs. Thank you so much for joining us. Thank you all for watching CNBC.com. I'm Frank Holland, anchor of Worldwide Exchange. I'll see you next time.